Welcome to Behind the Scenes of your Dunham portfolio, our discussion on the recent allocation changes made by the Dunham Investment Committee in the Dunham Asset Allocation Program. This overview will provide insight into the rationale behind the investment strategy, the risk management process, and the key factors influencing the decision-making of the committee. By the end of this video, you will have a deeper understanding of the allocation changes and the underlying investment philosophy of the committee. The Dunham Investment Committee engaged in a thorough discussion as they confronted a multitude of intricate questions regarding the course of inflation, the possibility of a recession, and the banking crisis instigated by Silicon Valley Bank, among others. The committee believes the Federal Reserve is nearing the end of its interest rate hikes, and we may see only one more 25 basis points hike. The action the committee took based on this view was to continue allocating more to duration-sensitive investments, such as the Dunham Corporate Government Bond Fund, the Dunham International Opportunity Bond Fund, and the Dunham High Yield Bond Fund. The committee feels that if we are approaching the peak interest rates, we can potentially expect to see a relatively strong yield. In addition, if interest rates drop due to a weaker economy, investors may anticipate both price appreciation and high yields. The committee's strategy is to increase the interest rate sensitivity of the fixed income portfolios in portions over the next few quarters, instead of all at once in the current quarter. This approach enables them to continue evaluating inflation and remain agile if inflation takes an unfavorable turn. If this occurs, the Federal Reserve may need to increase interest rates again aggressively. The Federal Reserve nearing peak interest rates could be a positive economic development, as it could mean avoiding a severe recession. Nonetheless, based on the tightening of monetary policy and the increase in interest rates that have already occurred, the committee believes that a moderate recession may be in the cards. To manage the risk of fixed income portfolios, the committee is slowly decreasing credit risk from their fixed income portfolios. The slower pace of this approach reflects the committee's view that while a recession may occur in 2024, it is not imminent in 2023. However, starting to shave some credit risk from its fixed income portfolios makes sense to the committee. As such, they allocated away from the Dunham Floating Rate Bond Fund, which carries credit risk, to the more interest-sensitive investments and ones with higher credit quality. If we look back at 2022, the committee overweighted non-traditional income funds, such as the Dunham Floating Rate Bond Fund, the Dunham Monthly Distribution Fund, and the Dunham Long-Short Credit Fund. These funds shared a common investment characteristic of historically having a low correlation to interest rates. This approach served the Dunham fixed income portfolios well in 2022, while the Federal Reserve increased interest rates. As mentioned, believing that the bond market is approaching peak rates, the committee has shifted its investment allocation to potentially benefit from a steady or even lower interest rate environment if the economy falters. Therefore, in addition to the Dunham Floating Rate Bond Fund, the committee has also implemented allocation shifts away from the Dunham Monthly Distribution Fund and the Dunham Long-Short Credit Fund. This proactive approach reflects the committee's commitment to adapting its investment strategy to changing market conditions to potentially enhance investor returns. The committee faced several challenging questions regarding equity investments, but two were particularly pressing. The first was the direction of the U.S. core equity portfolio in the event of an impending future recession. The second was the impact on the equity markets resulting from bank failures, such as the one recently experienced by Silicon Valley Bank. The committee concluded that the Federal Reserve's decision to tighten monetary policy and raise interest rates would likely result in an economic slowdown and a possibility of a moderate recession in 2024. Consequently, the committee believed that it was important to prioritize earnings resiliency, as they viewed the stability of earnings as a key driver of stocks in the upcoming quarters. To this end, the committee made several adjustments to the Dunham Core U.S. equity strategy. Specifically, they shifted allocations from the Dunham Small Cap Growth Fund and the Dunham Focused Large Cap Growth Fund to the Dunham Small Cap Value Fund and the Dunham Large Cap Value Fund. The committee believes that a shift toward value stocks may offer a stable earnings prospect that investors will look for in companies they perceive to be appropriately valued. Regarding the issue of bank failures, the committee noted that the FDIC's decision to guarantee all bank deposits at Silicon Valley Bank had averted a potential crisis. The committee did not change the equity portfolio in response to this development. The committee reviewed the core foreign strategy, deciding to shift part of the portfolio to capitalize on what they view as promising prospects within emerging markets. This allocation change is in response to the belief that global interest rates may be reaching their peak. The recent relaxation of China's zero-tolerance COVID policy could spur growth, and a strong economy in India and certain South American countries all could result in favorable returns for what they believe is an undervalued asset class. By taking an active approach, they adjusted the allocation by taking from developed economies in the Dunham International Stock Fund in favor of increasing the allocation in the Dunham Emerging Markets Stock Fund. Here are the changes made to the various Dunham asset allocation strategies as of March 31, 2023.